Welcome to the Three Edge Week in Review for the week of March 22nd, 2021. I'm Fritz Foltz, the Chief Investment Strategist here at Three Edge, and I'm joined here once again today by Steve Cucchiaro, President and Chief Investment Officer here at Three Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing the topic of market manipulation, and in particular, the effect that the central banks, such as the Federal Reserve, have had and are continuing to have on the global capital markets. But first, let's do a brief update on the market. And it was an erratic week on Wall Street. Saw stocks move high early in the week, then they fell back in the middle of the week, only to finish the week on a high note with both the Dow and the S&P ending the week at record highs. Commodities and gold also both advanced at the end of the week. Investors were encouraged by the pace of the vaccine rollout in the US as the Biden administration announced the doubling of their goal for vaccinations in the first 100 days in office from 100 to 200 million doses. An additional positive sign for investors this week came when the Federal Reserve announced an end to their pandemic-induced limitations on banks that had restricted banks from doing share buybacks and from dividend payouts. The Fed's policy goal was to ensure that the banking system had adequate capital to be able to make loans, even as the U.S. economy took a hit from the coronavirus pandemic and the pandemic-induced lockdowns. These days, investors are also focused on the U.S. government bond market, in particular auctions for U.S. Treasury securities, and whether the government is able to issue treasuries at auction easily, or is it proving difficult in forcing them to pay higher interest rates on these new issues. And inflation news, the index of consumer prices that the Fed officially uses for its target rose 1.6% in February, and that was the biggest gain in a year, although a lot of it was due to an increase in the cost of energy. The future path of inflation remains a hot topic on Wall Street in the wake of the $1.9 trillion stimulus package signed into law earlier this month. As the world emerges from the global pandemic, the Fed continues to insist that inflation surge would be temporary, while others on Wall Street point out that pent-up demand, rising materials costs, and the latest stimulus package stand to make inflationary price pressures more lasting than transitory as the world emerges from the global pandemic. So, Steve, let's move on to our topic today, which is market manipulation, which sounds kind of sinister, but it's really not the way we're talking about it. What we're discussing is how, beginning with the response to the financial crisis and then reaching into the last 12 months with the global pandemic, the Federal Reserve and other central banks have taken certain policy decisions to ensure the functioning of the financial system and the markets. And so even though these central bank policies were enacted for the right reasons, some of the policies have had a major impact on the markets. Some intended, maybe others unintended. So perhaps you could get us started and describe some specific examples of ways in which the Federal Reserve here in the US has had an impact on the markets and therefore could fall under the heading of market manipulation.
Well, Fritz, as you and I have discussed before, as students of market history, we can say that there's never been more market manipulation by the Federal Reserve Board and by other central banks than there is more recently. Traditionally, the Fed acted as a check and balance against politicians who were tempted to overspend to try to goose the economy before the next election, to try to boost their reelection odds. And so the Fed would come in and act as a check and balance to protect the value of the dollar, to protect the economy from going into inflation from all the overspending. And that's how it worked. And in fact, the longest running Fed chairman, William McChesney Martin, once famously said, the Fed's job is to take away the punch bowl before the party gets started. And that really had been the discipline of the Fed, just the opposite of market manipulation, but actually a check and balance and a discipline. And now you could say that, here we are in a time where the market is creating new records. We have market euphoria and all kinds of signs of that, as we've discussed previously. And yet you can say that now the Fed is spiking the punch bowl just as the party is ripping. Now, it's true that parts of the real economy are still hurting from the pandemic, but in terms of the markets, we're still hitting new records. So there's never been more market manipulation.
Interesting. And so also we do know that it's not only the Federal Reserve here in the US that has pursued unprecedented monetary policy. We also have seen the same outside the US from the Bank of Japan for many years and from the European Central Bank, particularly during the pandemic. So maybe you could touch on a few instances where we've seen ex-US central banks uh, creating monetary policy that's impacted the markets.
So this is a global phenomenon. Coming out of the financial crisis of 2008, the central bank in China, the People's Bank of China, unleashed massive stimulus, more than anywhere in the world. And this really did help the global economy recover more strongly than it otherwise would have from the financial crisis of 2008. But the unintended consequence was it left a huge debt hangover that's still present in China, in much of the world. Germany and Japan intervened to such an extent that they drove their short-term interest rates and many of their longer-term interest rates as well to below zero, meaning that you had to pay for the privilege of lending the government money. Sounds crazy. It actually happened. Not only did it happen, it's still in effect today. It's still going on all these years later. And then we have in Japan, in addition, not only like other central banks, are they creating reserves out of thin air and using that new money to buy bonds in the open market, but they're actually buying equities as well.
Right.
So market manipulation is really taking on a new level. Now, the fear is that it would hurt your currency, but since all the central banks are doing it, you can say that it's not so much one currency versus another, but all currencies have lost value relative to gold over the last decade and beyond.
Very good. So it seems to me that one very interesting thing that investors, and maybe the biggest risk that investors may face, is what will happen when the Fed and when the central banks decide it's time to unwind these, these extraordinary monetary policies that they've put in place. And that seems like it could be a danger zone because there would be uncertainty as to if it was unprecedented going in. I suppose it's unprecedented coming out, and so it's hard to know exactly what will happen. And then the follow-on to that is, well, what do you do if you're an investor to protect yourself from that eventuality?
So as investors, on behalf of our clients, this is of paramount importance. This is something that we're concerned with right at the top of our list. And as you've pointed out, Fritz, market manipulation can create these gaps, can distort fair market prices. And that's dangerous in the long term. It's always done for some short-term reason, some noble cause, but it's dangerous in the long term because when you distort fair market prices, you take away the most efficient way the economy knows how to allocate resources and to drive productivity growth. And so you're taking that ability of the market away, and that has longer-term implications. And as you pointed out, when you have market manipulation, you get larger and larger gaps between your current prices, market prices, whether it be bond prices or stock prices, and where they should naturally be if they were set by the fair market. And eventually these gaps have to correct. And that's the difficulty. So right now, let's just take as an example. The Fed is justifying their market manipulation by saying that, yes, we might have a spike in inflation in the short term, but it will be transient, it will be temporary, and we will still maintain very strong stimulus for several years. So the question is, what happens if that doesn't come to pass? Well, we know from history the Fed has a very poor track record at guessing what inflation or the economy or interest rates are going to do in the future. And economists also have an equally poor record. And this is not because the Fed or the economists aren't intelligent. They're very intelligent. They have a lot of experience, but it's because it's so difficult to predict what a complex system like the global economy is going to do in the future if you're treating it as a simple linear system of short-term relationships. So what we think is that we should be prepared, and our clients should be prepared for the possibility that this jump in inflation is not so transient, and that the Fed maybe does have to change their plans, and they're not able to hold interest rates at zero forever, And at the time when they have to start to act before anyone expects, that could really lead to a reset in the markets, both in the bond and the stock markets, especially in the markets that are most overvalued, like in the US. So that's why we're constantly looking at investing in asset classes that would not be so hit by that overvaluation caused by the market manipulation we've already had.
Great. That's a great update, and I think that's a topic that we'll be coming back to again. So that will do it for Steve and me. As next weekend is going to be a holiday weekend, we will not be creating a Three Edge video, but the following week we will, and that will be our monthly view from the edge, where Eric Beagleisen and I will look at our Three Edge research model and our outlook for the global capital markets. Remember, all of our videos are available on our Three Edge YouTube channel, as well as on our website. Our website is 3edgeam.com. So we wish everyone a happy Easter weekend next weekend. Thank you for listening. Stay strong and keep the faith.